Top 10 Money Bad Habits and Pitfalls. Money mistakes, especially in your 20s, are inevitable. But the sooner you figure out how to take care of your finances in some basic ways, the better off you'll be. Number 1. Waiting until you have more money to invest. Time is on your side when it comes to investing, thanks to the power of compound interest. And contrary to popular belief, you don't need to be a personal finance expert or even earn a massive paycheck to get started. Even if you can't invest a ton of money, establish the habit of setting aside at least a little bit each month. Whenever you get a pay bump or bonus, reevaluate how much money you can realistically set aside. Number 2. Spending all of your paycheck. If you're spending as much as, or more than, you're earning, you're living paycheck to paycheck, which can easily spiral into credit card debt. That lifestyle makes it nearly impossible to build up significant savings. The solution: live below your means, not at it or beyond. Number 3. Going without a savings goal. Money won't just appear if you want to save more. You have to have a clear goal and then set a specific plan in order to achieve it. Start by determining exactly what major purchases you hope will be in your future, like a home, car, or education for your kids. Next, determine how much you need to save for them and for how long. Finally, set up a recurring automatic transfer from your bank account to your savings account to ensure you'll stay consistent with your savings. Number 4. Making late payments. In addition to costing you money and fees, missing payments can lower your credit score, which affects your ability to borrow money for bigger purchases, like a home or car, in the near future. Never miss a bill again by setting up automatic payments online for fixed costs such as cable, internet, and insurance. For expenses that can't be paid online, such as rent, set up calendar reminders and pay them at the same time each month so it becomes routine. Number 5. Paying the minimum on your credit card balance. Most credit cards only require you to pay 1% to 3% of your balance each month. Paying the minimum can be a tempting option, especially if your budget is tight. But it can cost you a fortune in the long run because you'll have to pay interest on the outstanding balance due. Get in the habit of making payments in full. If you find yourself overcharging consistently and struggling to pay more than the minimum, try ditching your plastic for a while and going on a cash diet. Number 6. Having no idea where your money is going. Whether it's calling an Uber, stopping by the bodega around the corner every morning, or picking up a soda while waiting in the checkout line, it's all too easy to spend mindlessly. Try tracking your expenses to get a better idea of where you spend your money and where you can cut back. Don't stop there. Number 7. Dipping into savings. Once you set up a retirement savings account, keep your hands off of it. Besides facing fees, most traditional IRA withdrawals made before age 59.5 incur taxes and a penalty. You're putting your financial future at risk by preventing your retirement savings from growing over time. The same rule applies to your emergency fund. Don't touch it unless you're facing a disaster that threatens your survival. Number 8. Ignoring insurance. When you're young, it's easy to think you're invincible and forego insurance to save a bit of money each year. But even one accident can wipe out your savings. Insurance policies are largely personal. To get the best coverage for your specific situation, educate yourself by shopping around and getting multiple quotes. Reading your policy closely before signing on and asking questions when you don't understand. Number 9. Not prioritizing high-interest debt. All debt is not created equal. An effective strategy is to rank your obligations in order of interest rate, from highest to lowest. Then, prioritize the debt with the highest interest rate, while still paying the minimum on all of them, in order to pay less over the long run. There is an alternate option, too. Rank your debt in order of size and start with the smallest. The idea is that each time you pay off one form of debt, you build momentum, which helps you tackle the next biggest, and so on. Number 10. Trying to show up your friends. Living up to your friends' or coworkers' standards is tempting, and if you're guilty of it, you're not alone. A survey by the American Institute of CPAs finds that 78% of 25 to 34-year-olds use their friends' financial habits to determine their own. That being said, choosing where to eat, what to wear, and what gadgets to buy based on what your friends do can wreck your budget. Just because your friend seems able to afford the latest Apple product or an all-inclusive trip to the Caribbean doesn't necessarily mean you can. Thanks for watching video.